We may need to make a big purchase sometime in our life, be it for a vehicle or a home. And since most of us aren't Scrooge McDucks swimming in our piles of gold, to make these big purchases, we usually borrow money. And since we're borrowing a lot of money, sometimes the process that guides how we pay back our loan can get more complex with something called an amortized loan. In general, whoever we're borrowing money from is going to want that money back on time and with a little extra for their inconvenience. And that little extra can look different for everyone. I'm Jason Guglielmo, and this is Study Hall Real World College Math. When we started our unit on finance, we talked about how borrowing and lending money comes with costs, specifically interest. That interest might be simple interest if the payment is always based on the principal, or compound interest if the interest payment is based on the total amount owed, including any previously accrued interest. But until last episode, we'd pretty much assumed we borrowed money or invested a lump sum of money and then just left it. Now, we're ready to make things a bit more complicated. For instance, last episode, we learned how the amount of compound interest we earn can change if we regularly save the same amount of money, which is called an annuity. But sometimes we need to borrow money. And just like saving money with an annuity, in real life we often make regular payments on our loans. This is called an amortized loan. But it turns out, understanding amortized loans comes down to combining what we already know about compound interest with what we just learned about annuities. Let's try an example. Twins Malika and Sonia want to make some extra cash, so they rent a car to deliver food. They plan to borrow cars from the 3 Twist rental company on a weekly basis. Go in on Monday, get their cars, make some deliveries up until Friday, then return them. But those rental fees can add up fast. So Sonia thinks it would make more sense to buy cars, but isn't sure how the prices actually shake out with amortized loans, which are often used when buying cars since people tend to pay them off bit by bit. First, let's think about the situation intuitively. Well, on one side of the deal is the borrower. And from their perspective, the situation is kind of like an annuity, because they're making regular payments and interest is accruing based on those payments, even though the borrower is chipping away at a total rather than building it up. But on the other side of the deal is the lender. And from their perspective, the situation is more like what we described in the compound interest episode. They put aside a lump of money and don't do anything else to it. The interest that's growing is based on the entire amount owed each payment period, including any previously accrued interest. And we already built equations for both annuities and compound interest. So basically we can describe an amortized loan by setting our compound interest and our annuity equation equal to each other, since the amount we pay into the annuity and the future value of the loan should be equal. This equation lets us predict how long it will take for us to repay a loan like a car loan, or figure out what our monthly payments for a loan will be, or how much interest we have to pay, before we get locked into something we're not actually able to afford. That way we can easily compare the monthly cost of buying a car to the price of renting one and see if Sonia's right. Car rentals for Malika and Sonia cost about $260 per week, which comes out to about $1,040 per month. So that's the number to beat. Now it's time for Sonia to go shopping. Sonia goes into the dealership on a Sunday. She finds the car that she saw on the dealership's website with a sticker price of $16,000. While she's meeting with the dealer in their office, they start silently running some numbers on their computer. After adding on the sales tax and other basic costs, the dealer spins their chair around and presents Sonia with an out-the-door quote for the car at $18,000 even. That's definitely a chunk of change, so we can use that amortized loan equation to see what her monthly payments look like and compare it to her monthly rental car fees. Remember, the M represents the monthly payments. So let's work through a bit of algebra and set the equation up with M on one side by itself before we plug in the values, so we have fewer mental cartwheels to do. The denominator on the right-hand side of the equal sign can be multiplied on both sides. Then, the factor being multiplied with the M on the right-hand side should be divided on both sides of the equal sign. And boom! We have the M all alone. Then, to calculate Sonia's monthly payments for an $18,000 loan, we just need to plug in all the loan information as the variables. The principal of the loan she'd borrow is $18,000, so P equals $18,000. She was approved for an annual interest rate of 6%, so R equals 0.06, which is arguably not that great, but I digress. And she agreed to pay the loan off in 4 years, so T equals 4. The annual interest will be broken into monthly portions to coincide with the payments. So we need to break our interest rate into 12 parts and apply that smaller interest rate 12 times per year. The loan is also compounded monthly, so that makes n equal to 12. So, putting that all together, if she wanted to make monthly payments for 4 years and had an amortized loan for $18,000 with a 6% annual interest rate that compounded monthly, Sonia would have to pay $422.73 a month. Now, if we do some quick calculations, $422.73 paid 12 times a year for 4 years adds up to $20,291.04 for something that's supposed to only cost $18,000. So, at the end of this loan's life, she'll have paid the bank more than $2,000 extra dollars. First things first, Sonia needs to decide if she's okay with more than $2,000 in interest. That's a lot of money to pay on top of the original $18,000. 6% interest isn't a great rate, so she might want to shop around for some more options. But we'll run with this total for now. On the surface, $422.73 sounds like a lot less than the $1,040 she was paying each month in rental fees. But that's just the price of the car payment. We also need to consider the other costs that come along with buying a car, like registration, maintenance, and insurance. Even still, the monthly cost of renting is much higher than the cost to buy. So, Sonia decides to make the purchase. Her sister Malaika, on the other hand, doesn't want to pay that much interest. So, she decides to use the original equation we had from before to more effectively shop around. And since the monthly cost to buy a car is so much lower than renting, she decides that she's willing to bump up her monthly payment in order to pay off the loan in 3 years rather than 4. That way she'll end up paying less total interest. Let's put her info into the monthly payment equation. She gets the same $18,000 quote and 6% annual interest rate. N will still equal 12 since it's compounded monthly, and adjusting for a 3-year loan, her monthly payment comes out to $547.59. With all her payments added together, that comes to a total of $19,713. So if we subtract her principal, her total interest paid comes out to $1,713. Which is about $600 less interest than the loan her sister accepted. Including registration fees and maintenance, her monthly payment comes out to about $740, which she's pretty happy with. That's $300 less per month than it costs to rent a car, and at the end of the 3 years, she'll own the car outright, which will bring her monthly cost down even more. Now, we assume that Malaika got the same initial price as Sonia, but that's not always the case, even if they have fairly similar financial histories. According to an article published by the Georgetown Law Journal, this is known as discriminatory lending. Sometimes, even if 2 people try to get the same loan and they have the same income and credit history, their regular payments can be drastically different for reasons math can't explain on its own. Like, say Malaika and Sonia discover they have a third sister named Maria. Yes, triplets, separated at birth. Maria is more feminine presenting than her sisters and wants to get in on the family business. She goes into the dealership and sees the same deal her sisters told her about for $16,000. The same thing that happened to Sonia happens to Maria. She meets with the dealer in their office, they start silently running some numbers on their computer, adding on the sales tax and other basic costs. The dealer spins their chair around, but before Maria can review the quote in their hand, the dealer starts to tell her this story about when the car dealer's cousin borrowed their grandmother's car and totaled it, couldn't even drive it off the scene. And their grandmother still had to pay out that loan even though she didn't have the car anymore. All because she didn't have gap insurance. They tell Maria that if she buys gap insurance through the dealership and someone she loans the car to crashes her car, she won't be responsible for whatever is left over on the car loan and can just get a new car. This is just the first of many small car dealer add-ons to come. By the end of this meeting, the dealer has successfully got Maria to agree to a total of 6 add-ons offered by the dealer. The dealer reprints her quote, and Maria is shook. The $18,000 loan Sonia told her about is now $20,000. So here's the deal. Sometimes when car dealerships partner with a bank to offer auto loans, the bank basically tells the dealership, hey, you can offer your customers loans to afford your cars, but you better not let anyone borrow more than $20,000 from us. That's the cap. Other than that, do as you please. Car dealers can mark up the cost of any car on a case-by-case basis, and they won't get in any trouble as long as they stay within the bank's limit. That's exactly what happened here for Maria. Her sisters weren't offered any of those add-ons. But since the dealer assumed Maria to be more willing, they offered it. And just like changing the time period of the loan changed the monthly payment, changing the principal can also have a dramatic effect. Now that her principal is higher, that could make Maria's monthly payments more expensive than Sonia's or even Malika's. Maria's loan was calculated with the same annual interest rate, compounded the same, and for the same 4-year period as Sonia's. So, using the same amortized loan equation with M on one side as we did for Sonia's quote, we can swap out that $18,000 with Maria's $20,000. Running the numbers, Maria's monthly payment over 4 years would be $469.70. That's about $50 more per month than Sonia, but still less than Malika's. But we should also consider the total interest. Altogether, she'd pay $20,000 for the car plus $2,545.60 in interest, which is about $250 more interest than Sonia paid and over $800 more than Malika. Overall, understanding the math behind their loans gave our sisters the power to make informed decisions and save money. With a little algebra, they could hone in even more. For instance, maybe they have a set amount they want to specifically pay each month. So instead of solving for their monthly payment, they could rearrange the equation to solve for time to see how long it would take to pay off a loan. Or maybe they just want to check the math of whoever is giving them the loan so they can make sure they're only paying what they need to pay. Understanding the math behind these complicated financial decisions gives them an incredible amount of power and ensures they aren't wasting money. Now, Sonia and Malika can use the money that they save to maybe order some food themselves on their nights off and enjoy the sweet, sweet taste of financial security. That's not all there is to know about amortized loans though. What about down payments? And how do I keep track of how much I owe? We'll leave that for the next episode. Thanks for watching Study Hall Real World College Math, which is produced by Arizona State University and the Crash Course team at Complexly. If you like this video, give us a like and subscribe. You can learn more about ASU in the videos produced by Crash Course in the links in the description. See you next time.